the opportunity is to buy, good, well-designed vacancy. As I mentioned, there's, the leasing demand is low, but it's not dead. I think that when we still have tailwinds, we still have e-commerce, we still have onshoring, nearshoring, energy transition, with that manufacturing and whatnot. There is leasing getting done. It's a matter of buying the best, well-designed buildings in these markets, and making sure we price in the fact that it's going to take a little time to lease them.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals, provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Matthew Brodnik. Matthew is the Chief Investment Officer for EQT Exeter's North American Industrial Real Estate Platform. EQT Exeter is the real estate division of EQT, a purpose-driven global investment firm with $244 billion of total assets under management. And in just a minute, we're going to speak with Matthew Brodnik about the current North American industrial real estate space. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Matt Brodnik. Welcome to CREPN Radio.
Thank you, Darren. Glad to be here.
Well, I appreciate you taking the time to do this. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Matt Brodnik, as I mentioned, I go by Matt. You don't have to refer to me as Matthew. Only my mother calls me Matthew. I've been with EQT. EQT is the predecessor company to EQT Exeter. We merged with EQT back in 2021. I've been with the platform or with the company since 2008. I joined in September 2008. Prior to that, I worked with a Philadelphia-based development company. And prior to that, I was in business school at Northwestern University and graduated from there in 2003. Prior to that, I attended Villanova University, where I got my undergrad. So I've been in the real estate business now for over 20 years, between the time here at Exeter and in the development space. Principally focused here at Exeter on, as you mentioned, the industrial side. At Exeter, EQT Exeter, we also obviously get involved in other asset types where we own and manage multifamily throughout the U.S., Europe, and Asia, as well as office. But U.S. industrial is my focus, and really where it all began at Exeter almost 17 years ago.
Got it. Well, the industrial space is fascinating. I know. Through the COVID, it was, I'd heard, and I'm hoping you can kind of shed some light on this, but there was projections of growth that were supposed to be met, like, in the future. And from what I understood, based on the kind of everybody stay at home and supply chain and all that fun stuff, that the demand was growing faster than what was projected, and it's supposed to reach like future dates. It was reaching much sooner. So I guess one of the things I'd love to start with is just kind of from your vantage point, the industrial marketplace, pre-COVID, through COVID, and what you're seeing going forward.
Yeah, I mean, I remember back when, I started at Exeter, and Exeter was a new investment platform. Industrial wasn't popular. We would be explaining to investors why industrial, why it's a real sector. The sectors people wanted were office. They wanted, retail, multifamily, and industrial was considered that outlier. And really, I mean, we talk about e-commerce. Obviously, COVID was more of an igniter. We saw e-commerce adoption obviously pick up for obvious reasons out of necessity, but it was there before. And I would say we've seen that industrial demand, construction, the growth in industrial really going back, well beyond 10 years into the global financial crisis and prior to it. And so we had been on this kind of upward trajectory since 2009 or 10 of, positive absorption, construction deliveries, and it was really a steady increase. And obviously in 2021, we saw, record, leasing, construction starts, and really that ignition wasn't just really, the e-commerce demand, but also supply chain issues that drove a lot of that leasing, a lot of that growth. And we're still seeing it. I mean, those tailwinds are still there. But obviously we'll get into this. I'm sure they've been muted a bit or taken a step back a bit.
Got it. And I might have jumped ahead of myself. It was kind of on top of my mind, but let's back up just a second here and talk about EQT. And if I understand right, you guys are a fund, is that correct?
Right. We are a fund manager and operator. So that's an important distinction. As a fund manager, we invest in real estate through private equity funds, sector-specific funds. So we have funds that invest in U.S. industrial, across the board, from core plus to value add. The same thing for office and multifamily. And those funds, we also have European funds that do the same thing. We're a pretty large operator in Europe. Actually, in the United States, I would say we're the third largest operator of industrial. And we're growing quickly on the multifamily side. And then we've been in office our entire careers and here at Exeter since the beginning as well. Asia, we're growing in Asia as well, and so we have a larger platform there. But I would say that with us as a private equity fund manager, we invest capital on behalf of our investors, institutional investors, pension funds, sovereign wealth investors, and whatnot. So that's us as a private equity fund manager and investor. But we're also, what makes us unique is that we're an operator as well. When I say we're an operator, we lease our own buildings, we buy buildings, we develop them, and we manage them all in-house. So it's very important. I say that and kind of provide some distinction because others will say the same thing. But when I say we lease our buildings, we have 24 offices around the United States, and those offices are in the markets in which we invest. And those offices are staffed by an investment leasing officer, and that person's job is to identify buildings to buy. Then once we buy them, to oversee the leasing. We have property managers who actually manage the properties. And then we have development managers that oversee the construction of buildings. So in many ways, we do it all ourselves. So as an operator, as a manager, we're not just investing in buildings from Philadelphia and saying, hey, I'm going to go buy a building and you're in Portland from Philadelphia. No, we have a market officer in the Pacific, in the Northwest, Chad Rawlings, who runs our office out of Seattle, and he buys buildings in Portland and Seattle and manages them. He buys land and oversees all of that. So that's what makes us very unique. I don't think there's another firm in the United States or in the world actually that does it the way we do it. And it really harkens back to kind of how we viewed real estate or what we saw from the great operators like the Trammell Crow companies and Heitman back in the 80s and 70s, where they'd have these partners, often different offices, buying the real estate, real estate's a local business, right? You need to know access, highway access. What's the right building for the market? Who are the tenants in that market? You need to talk to the local players. You need to understand zoning and the different nuances of each of these markets, and then know the tenants. Our industry is one of the few, or our business is one of the few, where most of our competitors outsource the tenant relationship to the brokerage community, which is absolutely insane. I mean, we're here to serve the tenants. So, you know, in our minds, we need to have first name relationships with the heads of real estate at all of our tenants. I mean, if we're doing a deal with a Fortune 500 company, we're typically doing a deal with them in the United States, in Europe, and Asia, and it's usually the same decision makers making the decisions of where to put their buildings or where to lease space. So we want to have that direct relationship with them. So yeah, you know, while we're a private equity fund manager, we're a real estate operator in every sense of the word.
Got it. So just to be clear, are there any situations where you would invest in some property owned by others or another fund, or is it strictly everything that all the capital raised through the fund is invested in properties that you acquire, manage, operate, or develop in-house?
I would say that is almost always the case, with the exception of a few times where somebody might own a piece of land and they've gone through the entitlement process. They're a local owner and they're looking for a partner to come in and help them construct the buildings. In that case, we're bringing our tenant relationships to bear in those cases. So we'll partner up with someone and effectively use their skills on the develop or work with them utilizing their skills on the development front, but bringing obviously our operating know-how on the leasing to bear. So we'll do that in some cases, but by and large, we typically own, manage, develop, and lease on our own.
Got it. So from ground to lease up, you guys are taking it in-house. I assume all of the construction trades and that are you subcontract all that out?
Yes, so we'll work with the general contractors and we're act as the developer. You know, obviously we engage the architect and the engineers and the general contractors.
Got it. So let me ask you, so as a strategy, you mentioned kind of a wide, many different asset classes, and I assume are the funds then specific to the asset class?
Yeah, so when I mention them as sector-specific funds, our investors that invest in industrial, we're buying industrial buildings in our industrial funds. We're buying office buildings in our office funds and whatnot. So, we're very focused on that. Our industrial team, our industrial operators, our industrial team doesn't go out and buy multifamily because we're experts on logistics and in the industrial space.
Got it. No, that makes complete sense. So let me ask you then. So you, I'm familiar. I mean, I've had, many conversations about syndication and that where, you identify a particular asset, raise capital, secure, a loan and acquire, operate, and then sell. And I'm curious with a fund, and as large as EQT is, how, when you acquire a property, when you identify a property, is there a kind of a date on the calendar circled that, or a hold time identified at acquisition, or is it, are you guys more of a forever hold?
Well, I think it depends on the vehicle, and our core strategies. The opportunity is to buy real estate, long-term leased real estate, and hold it, and earn cash flow, pay dividends to our investors. In those cases, we're obviously buying buildings that we believe will stay leased for a long time, and that will provide that cash flow. So we're looking at them on a yield basis, taking into account leverage. We typically put 50% leverage, say, on our core investments, and are looking for a cash on cash return that as I mentioned, pays dividends. On the value side, I mean, we're looking at buying a real estate asset, whether we're buying 100 buildings in an assemblage in one transaction, or we're buying one building. We underwrite each building individually, and the goal is to obviously stabilize the property. Usually that happens within 5 years, and really build up a portfolio of buildings through one-off transactions or multiple transactions, and really market that value add portfolio, turn into effectively a core portfolio by stabilizing it. So there are really only three value add strategies. Either you can buy land and develop on it, you can buy a short-term lease building and renew the tenant or reposition the building to be leased once that tenant leaves, or buy vacancy. In each of those three cases, there's an active function that we have to do. We have to do something. We have to either, reposition the building, market it differently, making a capital investment into it, re-entitle the land, that type of thing. And then we can create value by stabilizing the asset. And usually we're looking to do that within the first few years of ownership. But ultimately the goal, is on a value add asset is to hold it and transact within 5 to 7 years or so.
Got it. So you mentioned leverage, around 50%. That would seem like you're, in a pretty strong position as far as cash flows. When you are with a fund, I'm just kind of curious on the mechanics of the fund, because obviously the fund is are you selling shares? I mean, is it more of or just a capital raise based on you raise enough capital to go out and acquire more assets, or?
Well, typically in a private equity fund structure, similar to what, the way other private equity funds do it, like Blackstone and KKR and some of the others, there's no difference. We raise capital from our investors. They make commitments to invest in the real estate. Then we call their capital as necessary until you've invested all the capital that they've committed to you. And so that's how that model works.
Got it. And then the valuation of the fund, is that a function of the value of the real estate, or is it more a function of the return that's generated?
Well, I mean, they all kind of go together, right? So obviously, when you're buying real estate and within a fund, you're building up a fund of real estate. And so, say you have a fund that's a $1 billion fund, and you go and you buy 70 buildings or so, and you aggregate that into a fund. You still underwrite each and every building on its own merits. And when you value the fund, it's really just the assemblage of the values of those individual buildings.
Okay, so it's not an open-ended fund. Okay.
Yeah,
gotcha.
These are all closed-ended funds, and we believe in that closed-ended fund structure, and that's what we have. We typically have a period of time to invest the capital, buy buildings, we buy them, and then we manage them, and then ultimately sell them.
Got it. That makes sense.
There's no open-ended. Investors don't come in later. Once the capital raising period is over, it's over, and we're investing the capital.
Now that was a little easier to understand. I was just had a thought of like, what is it? If it's open-ended, jumping in and jumping out and valuing, putting a value on the fund would be a little more tricky. All right. So we talked about kind of your different strategies. Is there I don't want to say a preference, but is there one that you've been more involved in as of late, say the last 5 to 10 years, as far as between development, vacant reposition, or what was it, the other one, the lease, expiring lease kind of thing? Is there
short-term lease buildings?
Yeah. Is there a strategy that you found to be more, or any one of those have been more active?
It's interesting. I would say that the percentage in each, we obviously put charts together to show how each fund invests capital in terms of the 3 strategies. And I would say that kind of during that post global financial crisis recovery period, the percentage of development went up from 20 to 35% of that with vacancy being another 30% and the short-term lease being equal. I would say during the COVID kind of post-COVID recovery era, 21 to 22, I would say more of that was development. So that development piece was up to as much as 40%, with the short-term lease being a larger portion and vacancy being very small. Because if you'll remember, in 21, with valuations as high as they were and the cost of debt low and the amount of leasing being done, people were valuing vacant buildings as if they were leased. So it was very hard to create value buying an existing vacant building. So we saw that trend move. I would say now, in the environment where we're in, and it's a much different environment today than it was over 21 and 22. And I'd say, that investment type more is going to be focused on vacancy and short-term lease buildings with almost no development today. But development will definitely be a part of our strategy over the next few years. But today the key is really focusing on really buying vacancy and short-term lease buildings at pricing that I'd say that is significantly lower than it was a couple of years ago. A lot of that obviously because we're in a market, and if I start going off on a tangent, tell me to stop. But we're in an environment right now where over 2023, I think over 500 million square feet of industrial inventory was delivered, right? A lot of that construction started in 21 and early 22. Those buildings were complete, but we saw absorption drop, so leasing dropped, over 50%. I think we saw something like 200 plus million square feet of absorption in 23. So you do the math, you're 500 plus thousand square feet of new buildings, 200 million square feet of absorption. We built up a bit of a supply overhang. So in a lot of markets right now, there are too many industrial buildings for the tenants that are out there. And I think industrial leasing demand is going to continue to be a little slower this year as well, like it was last year. So you have buildings that are going to be sitting longer. Owners, developers that need to get out. Simply put, we're in an environment where there's very little debt liquidity, right? Banks are not lending like they did, if at all. Lending or borrowing is through either the debt funds or through the life insurance company side. And so you have owners that have a lot of debt on their buildings that's going to be coming due. And I think that's going to force a lot of transactions this year. So the opportunity is to buy, good, well-designed vacancy. As I mentioned, there's, leasing demand is low, but it's not dead. I think that when we still have tailwinds, we still have e-commerce, we still have onshoring, nearshoring, energy transition, with that manufacturing and whatnot, there is leasing getting done. It's a matter of buying the best, well-designed buildings in these markets and, making sure we price in the fact that it's going to take a little time to lease them. And then move forward with that strategy.
I'm curious, on a cost comparison, and I would assume, the market price changes dramatically from, like you said before, when the demand was strong, vacant buildings were being priced as if they were fully occupied. Now that there's this supply overhang, is there any kind of a sense of a discount you would expect from, the high to what you're seeing now on the opportunities?
Yeah, I mean, we throw percentages around, but I think we're seeing, pricing, if the building's leased versus vacant. And obviously just taking a simple example, like I think we're the largest landlord right now in Indianapolis. It's a big industrial market, right? Big box market, typically larger buildings. In Indianapolis, it would cost, I guess, if you started a building in early 22, a 500,000 square foot building would cost like maybe $85 a foot, a bill a foot. And today you get a rent that's probably around 5.25 or so. I think that's about a stabilized 6 yield on cost. Well, today that those economics don't work, right? You have that vacant building, you spend $85 a foot to build. If I'm a buyer, I need a yield that's over, that's maybe 150 basis points over my exit cap rate. And if exit cap rates in Indianapolis are around 6%, I need a 7.5 stabilized yield on cost. So I'd pay that developer maybe 60, 62, 63. I'm doing the math on top of my head. So if I'm wrong, let me know. You need to be in that low $60 a foot or mid $60 a foot number. So that's a pretty big discount to replacement cost. That developer is going to lose money. The building should still be valued over their cost of debt, but there's no way that developer is going to be able to refinance that building out in today's environment. So I think what we're seeing is more valuations dropping, because of those yields. It's the cost of debt today, and then the need for higher stabilized yields. That same building in 2021 at a 6 stabilized yield would have been right because its exit cap rate would be 4.5%. That exit cap rate's obviously 150 basis points higher today.
Right.
So that we're really seeing that story kind of spread among all of the markets. I mean, it's really most pronounced, I'd say, in places like Southern California, New Jersey, where those valuations went up so dramatically and investors were willing to take such low yields. Today, that right sizing is creating even a bigger impact.
So you identified a couple of markets where it's prevalent. Are you seeing the primary issue being the new construction that hasn't leased up, or is there any concern with properties that have been leased up that aren't performing?
Um, I think when you ask, buildings that have been leased that aren't performing, meaning they've gone vac, they were leased and now they're vacant type of thing.
Well, I'm thinking of just a building that's performing, period.
Mhm.
You've got tenants, they're leased up, versus I mean, it makes sense to me if you get an empty building that you were expecting to have full and you've got a bank note that's, coming due, that's a problem.
Yeah.
But if you have a leased up building and you're 50% leveraged, I'm assuming that's not necessarily a problem. Is that, or are
I
you
think for
seeing?
most, right. I think, it's one of those things, what we saw during, during those COVID years was a rapid increase in rents, right? So if you bought a building in 2018, you leased it on a 10-year basis at a rent that's, maybe 30% below where rents are today, and you put 50% leverage on it, you're fine. You should be able to wade through all of this and hold the building. But I think it's more for those that bought a building leased, or leased it to a very low yield, say a 5% yield on cost or so. And now today, they're in need of new debt, or their debt is already at a floating rate debt, and they're paying, a 7% interest rate. They're struggling to cover that debt service. And they haven't if they didn't fix their debt when interest rates were low, there is that struggle. And so, we've seen a number of leased buildings transact over the last year, and I think it's more those sellers that really need to sell. It's not so much anyone marketing their building today, for the most part, isn't marketing it because they think it's a good time to sell real estate. A lot of times there's a driver behind it. Maybe the fund that the building was owned in has come to an end. There's a loan maturity coming up where the math just doesn't work, where they were financed at 65% leverage and now it's an effective 80% leverage. There's still equity value in it. They need to transact before refinancing it. Or simply put, there's an issue with the fund. Where we've also seen cases where maybe, it's a fund or an investor that owns a number of office assets, and they're struggling on the office side and need to raise cash fast. And industrial is still an attractive investment or an asset type, so there's definitely a market for it. And they'll sell the industrial to stave off issues on the office side.
Yeah, no, definitely the office is a riddle yet to be solved. And I don't know. I mean, I keep hearing that there are people that are starting to go back to the office. Not necessarily the frequency or the what it was pre-COVID, but that is a balloon, or however you want to or however you want to say it. It's something that's going to come to be realized in a hurry here, I think.
Well, I think we've been seeing it for the last year or so, and we're seeing it right now. I mean, a lot of the lenders I've spoken to over the last 30, 60 days have been talking about how it's time to start realizing those losses, or realizing those situations, instead of maybe extending the loan on that office building, underperforming office building. It's time to either force a sale or foreclose on it. And so we're seeing, on the office side, I think it's going to get a lot worse before it gets better on the office side. And I think valuations are going to continue to come down for a bit. I think office is a 10-year. I think it's going to take a long time to get through where we are right now. I mean, the return to work thing is one thing, and we're starting to see that in more places, but it's not really the rank and file worker that we're talking about in terms of return to work. It's the manager, it's the management level people
Right. Right.
that need to come back to the office. And I think it's going to take time. I mean, I think if you look at the world of office, there's a big chunk of those office buildings that'll never be office buildings again. Will just have to be converted to some other use. And I would say about 10% of the buildings out there right now are ones I look at and say, hey, that's a building that's going to remain leased. That's, when there's, any leasing demand available, or the last 10 to lease an office space will lease that building. Those are the ones I want to look at and identify. And even those buildings are typically going to be in distress because of they just simply need a basis reset. They were bought at too high a price at one point. The equity, the debt is poorly structured now in today's terms, and something needs to happen. So those are the office buildings that I would say are the attractive ones to buy today.
Right. Right. No, I've always, or haven't always, but ever since I've kind of understood real estate, the buy is where you can, really set your success. Is if you're buying at a below market point, and then if you have the good fortune of time and appreciation and demand, you can have an attractive exit. So seems like those that are able right now to grab some of these underperforming, lower priced assets that also have the ability to reposition and give it weight, I guess, is the give it some time, could have a really nice exit. But definitely going to be some interesting repositioning with the office assets. So let me ask you on the deals that you guys are involved in. Is there a deal size that's typical for your industrial assets that you develop or acquire?
So historically, we've been a buyer in small bite sizes. So we can buy, I think our average investment size is, is probably $25 million or so. So we do a lot of transactions. I mean, I think in 2021 we did almost 120 deals on the industrial side, and so that's the market. Our people in the field, our investment leasing officers, are quite literally driving neighborhoods, industrial neighborhoods, looking at warehouses and saying, "Hey, I like that one over there. Maybe we own a building next to it, and we just leased it, and we see the building next door is available, or there's something we could do to it to improve it, and we'll go make an unsolicited offer on it." So it wouldn't be surprising. I think since the beginning of the year we've made 56 offers on buildings. So we're kind of constantly hunting for real estate we like, and whether it's being marketed or not, and making offers on it. So it's a we're looking at a lot of different deal sizes. What I would say though is that we typically target supply chain real estate, we call it. When I say supply chain real estate, meaning we're looking at the same tenants. They're typically larger distributors that are either occupying everything from a 1 million square foot distribution center in central Pennsylvania to a last mile facility that may have been maybe 30 years old, closer in here in Philadelphia, at 50 to 100,000 square feet, and then all the way down to a truck terminal that might be operating closer in. In those cases, we're still dealing with the same tenant type. Those that are typically larger and just more on the distribution side. What you typically don't see us buying are more of the smaller multi-tenant industrial, where the credit might be less. There's more rollover, higher costs on the transaction side or on the leasing side. So typically with those supply chain tenants, as you say, there's a lot of repeat business. So we'll do, as I mentioned, transactions with them in Pennsylvania and in Seattle and France and Australia. So those global relationships, we tend to see more opportunity in having them.
Yeah, I would think having a partner like that, essentially, with those, are you typically finding a solution to a problem that they've expressed, saying, "Hey, we want to expand in this market," and that's kind of what you guys are cued into, that gives you the impetus to find a solution or an opportunity in a particular market?
That's it exactly. I mean, that sums up kind of our acquisition strategy. We don't really say we have acquisitions people, we have leasing people. And so when we meet with a tenant, they'll give us their needs. They'll tell us, "Hey, this is over the next 5 years. This is what we're looking to do. This is where we want to be, and this is the kind of building we want." And then we go find it for them effectively. Whether it's as I mentioned on the larger building side, it could be a build-to-suit opportunity, or it could just be making sure we have that availability for them. So we do have a team here at Exeter that maintains these relationships at a global level. While we have our people in the field, we also have folks here that focus on those larger relationships and keeping track of what those tenants' needs are. So if you're meeting with these tenants like a Target, a Lowe's, a Home Depot, and an Amazon, and they're kind of all saying, "Hey, I want to be I want to be off I-81 in Pennsylvania near the I-81/78 corridor, and I want to be in this area specifically. And you're hearing it from all the same tenants. It's a pretty good idea to go buy land there and focus on buying buildings in those areas. And really focusing on that more than, say, reading Green Street and hearing what Green Street, the REIT that does a lot of the REIT research, where they tell you to. I always kind of laugh when I see a publication called a market a bad market and a good market. Then I go and I talk to Target and they tell me exactly where they want to be. I'm going to listen to the tenants. They're going to tell me where the good markets are. So that's your question was spot on. Absolutely.
So, I mean, just that relationship alone seems like you guys would be a couple steps ahead of anybody that's speculating, kind of thing. Because, I mean, essentially, or let me ask it this way. You've had the conversation, they've said where they want to be. You go find an opportunity. Are you presenting it to them prior to locking up a particular piece of land or, property?
No,
As
I mean, I think we have a general idea of where tenants by and large want to go by talking to them, and we'll speculatively buy land and we'll build on it, and we'll buy, vacancy existing buildings that we can put together for them, and it's also on building size, in terms of what they're looking for in the different places. A tenant looking to distribute maybe out of Charlotte, might not want a 1 million square foot building like they would in Atlanta. From a distribution perspective, they probably want something, maybe they want something smaller. So we know that, hey, don't focus on 1 million square foot buildings in Charlotte. But but on the other hand, we do have tenants that, we will specifically go and look for land and opportunities for them, tie that up, put that opportunity together and bring it to them. But a lot of times, when we're looking to buy real estate, we're telling the seller that we're a short close. We understand the market, we understand the neighborhood, and we're going to buy it, regardless of what the market, of what happens. So when we put something under contract, we're going to close, barring environmental issues or sudden changes in the environment.
From the identification of a property to a leasable space, I'm talking about probably more development than the other options. What kind of a time frame are you seeing as far as, again, you've identified it, or let's say acquisition. So, because I'm assuming in identification, there's probably a fair amount of due diligence that goes on, but once you've acquired it to having it leased up, what kind of a timeline are you looking at?
So if I'm buying a building, let's say it's a vacant building, and I can tie it up and do my due diligence within 25 to 30 days and close 10 days after that. So I can typically close in 45 days on average after I've made an offer on a transaction, the seller's accepted it. And then typically, we project lease up periods depending on kind of the location, what we're seeing in the market. If I'm buying a vacant building in Dallas right now, and I'm buying a 500,000 square foot vacant building in Dallas, I know that there's almost 80 million square feet of availability, and there's something like 24 buildings available of that size in an area. I'm going to project it takes quite a long time to lease that building. I'm hopefully buying a building, or I'm expecting to buy a building that I think is the next to lease because it's functionally excellent and has certain qualities that the other buildings don't have. But so it might take longer. There are other buildings, though, in Dallas, where there's a lot of availability. We just bought a building that was 200,000 square feet in East Dallas, Mesquite, and we leased. We have 3 tenants interested in. We closed a week ago. In that case, we looked at scarcity. We said, hey, we know that this market is a good market. We understand it. We looked at how many vacant buildings of that size there were. We knew that there was a good amount of tenant demand in that size range. So we made offers on every 200,000 square foot building in East Texas or in East Dallas. We bought one. We like the one we bought. It has a good amount of outdoor storage. It's functionally excellent. And sure enough, it's going to lease, faster than we'd project. So it really is in terms of projecting lease up and stabilization, it really depends on all those different factors. Are we buying into supply scarcity? Is the building excellent? What does that tenant demand look like? On development front, it can take a very long time. I mean, obviously with land, where you are in the Pacific Northwest, especially, it can take 3 years to entitle a piece of land, through zoning, through site approval, just getting the appropriate entitlements. And then from a construction period perspective, we've seen construction times come back in a little bit, but it could take 12 months to build a building. I think pre-COVID, you'd say 9 months. During COVID, it got it to 2 years, and now we're probably back to somewhere closer to that 9-month period, 10, 11, 12 months.
Yeah, no, things got a little out around there with the COVID years with the supply chain. I was just amazed at how much, that put everything into shock. You just couldn't get things.
Right.
And I mean, demand was off the charts. So it was interesting times. So we've talked a little bit about kind of the marketplace. Are you seeing, as far as cap rates, forever they were compressing? Are you seeing, obviously we talked a little bit about, the cost of capital and just, what it's doing. Are you seeing cap rates back to like what they were pre-COVID, or?
I think we're seeing cap rates back to kind of where they were a couple of years before COVID. So, I think industrial cap rates on core real estate, and there are a lot of brokers out there that will get mad at me when I say it, but are probably closer to 5.75 in the tightest markets to 6.5, 6.75 in more of your Midwest markets. So I think those cap rates, a lot are driven obviously by cost of capital, where, if you're borrowing at 6% interest, you're not going to pay a cap rate on a long-term lease building below that. I mean, there's negative leverage makes no sense. The math doesn't work. If you're an investor, why would you do that? You go buy fixed income, go buy, corporate bonds, or go buy debt. Don't buy real estate in that case. So I think by and large, we've seen that pricing move appropriately. And I would say, 2023 was slow. There weren't a lot of sellers out there. There was a big bid-ask spread. You had a lot of folks that had their 4.5 cap rate offer from early 2022, and we're holding on to that, saying, hey, this is what the building's going to be worth, and it'll be worth that again. But I think what happened in 23 is all that hope of interest rates coming back down, things were going to get better. It's, everyone kind of realized it's going to be higher for longer. It's the Fed, saying, hey, the interest rates aren't coming down anytime real soon. So, I mean, we saw cap rates, or we saw sellers come to grips with where that pricing should be. I mean, we own a lot of real estate, and we're a seller of real estate. So it took us a while to come to grips with it as well. So I think that pricing is set. And I think, from a stabilized yield for value add investments, if cap rates are closer to 6% for leased buildings, you really need to be stabilizing buildings to, mid sevens on a yield basis to have that investment make sense these days.
Yeah. No, it is an interesting kind of a roller coaster, and to watch it happen in real time. And I think the lag, I guess what's interesting to me is just the lag, from recognizing what was to now accepting what is. And, I guess then what's interesting to me is how once the market kind of accepts this is it, how then it kind of gives them permission to kind of go forward at a more aggressive rate than if they keep, if it keeps hanging on and hoping that it's going to return to what it was or what it might have been. And then, the weird thing is what's to drive the market again into a rapid frenzy. I mean, it would be I'm assuming the economy would have to do much better, and there'd be some interest rates, cuts and demand. I mean, if there's demand will funnel or fuel a lot of that. So,
and I would say, and obviously we're buying real estate right now, and we bought real estate at the end of the year. So I'm the highest paying buyer in a lot of these cases, right? I'm in first place on the bid. So when I talk about this stuff, it's if we're as aggressive as the market is allowing us to be. But I do think when cap rates move, it's a combination of things, right? It's not just interest rates. Interest rates came down. I think in October the 10-year Treasury hit 5, and now it's somewhere around 4.1% today. And it dropped down below 4%. And but we didn't see an 80 basis point or 100 basis point drop in cap rates with interest rates coming down, because leasing demand. This whole notion that and I hear this especially with the younger people here, that rental rates keep going up, leasing rates keep going up. They don't ever, they always grow, right? But now we're seeing them not grow. In some cases going backwards. So I think when leasing demand picks up, and we see leasing rates increase again, interest rates come down, and you start seeing those lower cap rates. And it won't happen. I mean, the interesting thing about all the supply I mentioned that's in the market right now is that nobody's building a new building today. I mean, there are no new construction starts. So those buildings will lease that 500 million square feet that was delivered. And we will be in a point in the next couple of years, I'm pretty certain that we'll have supply scarcity again. And sure enough, we'll be building, and I think we'll be seeing rental rates go up, especially in those markets where, like the one you're in, where there are a lot of land use issues, and it's hard to find land, it's hard to develop warehouses on land. So it's going to come back, and it's just a matter of being there until that happens, and obviously now making those right investments and transacting, preparing yourself for that period of time. I just don't know whether it's going to be 25, 26 or when, but it will happen. Yeah.
No, but again, that cycle, that when demand is hot, everybody's trying to build, and then all of a sudden demand stops, and you've got an excess of supply, and then you got to wait for it to get absorbed. And so it's all kind of interesting. But hey, Matt, if we could, I'd like to shift gears here for a second. As I mentioned before we started recording, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be your investors, the marketplace, interest rates, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I am not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Matt Brodnik, what is the biggest risk?
I mean, I think I've been harping on tenant demand all this time, and as I mentioned, tenant demand hasn't disappeared. It's still there. I mean, we talked about demand kind of reverting to the mean, and right now I'd say demand is fallen below the mean a little bit, which is expected. I mean, tenants leased a lot of space in 21 and 22, leased more than it turns out they may need now, but they're not giving it back. They still need it. And I think what happens in recession, which we haven't seen, we're not in a recession right now, and there's talk right now with the Fed that there's this whole idea of a soft landing. Employment's near 100% here. We still have economic strength and growth, and as long as we do, tenants are going to need space. And I think the biggest risk for us right now is recession and tenants actually giving space back like they did during the global financial crisis, and that demand disappearing. And I think then that's the big concern, that demand going, really, falling through. And we talk about it, if you talk to an office investor in 2021 during the pandemic, they didn't forecast that this whole return to work thing would, or this work from home thing would last for 4 years. They didn't even see it as a risk at all. So I think, and that's what's killed the office world, right? Is that tenant demand is completely disappeared, and not just disappeared, but they're actively giving space back. It's going backwards. So that's the risk we see is this whole interest rate environment. Maybe there's another black swan event, something to happen. Obviously, we talked about it as a black swan event, meaning you can't predict what it is, but it seems like war between Russia and Ukraine and Israel and everything going on in the world. That is a real risk that something else comes and there's another shock to the system. So that tenant demand, that's the thing that we sit up at night thinking about and focused on.
Yeah, that is a risk. I mean, as a landlord, you want full buildings. That's when they work best. So.
Occupancy kills.
Yeah.
I mean, I'm
Yeah.
sorry, vacancy kills and occupancy is everything.
Yeah.
And it is something, we talk about that. I remember in 21, I was at an event, I was talking to a developer who I know, he was well known, and he mentioned that he wasn't going to lease his building that was under construction. They just started construction, refused to lease it, saying, we're not going to respond to any tenant inquiries. I said, well, why wouldn't you do that? Would you want to lease right away? He goes, no, I want to be there for the rental rate growth. I mean, rents are growing so rapidly. Why would I lease it now before the building's done? I'm going to wait till it's complete. And I remember hearing that, and that wasn't unique to that one developer. It was a pretty constant theme of 2021 and not really early 22, but 21 for sure. And sure enough, that developer has a building right now that's been vacant for a long time. And I'm sure, you look at that and say, wow, that's that tenant demand risk, right? That's what I was talking about. So you lease your buildings when you can. And so that's something that, that sticks with me. And when I think about, that whole idea of tenant demand, it's lease the buildings now and it's for as long as possible.
Amen to that.
Yeah.
Hey, Matt, where can the listeners go if they'd like to learn more or connect with you?
Well, I'm on our website at EQT Exeter, and I'm on LinkedIn, I'm very active in the industrial real estate world. I'm a transaction-oriented person. I buy real estate for a living, so I'm interested in seeing any opportunity anyone has and evaluating and understanding it, and I have a large appetite right now to buy real estate.
Great. Matt Brodnik, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.